Good evening, everyone. Thank you for joining this evening's Corporate Connect featuring NetLink NBN Trust, and we would also like to welcome our audience from Facebook Live. This webinar is organized by SIAS and supported by SGX. We will kick off today's webinar with a presentation by Mr. Jeff Howie, market strategist from SGX on recent market highlights, followed by the corporate presentation by Mr. Tong Yu Heng, Chief Executive Officer, NetLink NBN Trust. We will then end off with a Q&A session. NetLink NBN Trust was established in 2017 primarily for the purpose of owning all of the units of NetLink Trust, through which NetLink NBN Trust owns the only nationwide fibre network supporting Singapore's next generation nationwide broadband network. Without further ado, can I invite Mr. Jeff Howie to present, please?
Sure, thanks, Rebecca. I'll try not to take too much time because we are all very much looking to hear from you, Yu Heng. Very quickly, just take a quick 10-15 minutes just to provide a very quick reintroduction to the stock market and just quickly run through the current drivers of the market, what's been basically driving this rally that we've seen in the STI for the last month or so. But before we do that, just for context, our STI has been among the best performing indices so far this year, very comparatively defensive with a 9% total return versus the FTSE Developed Index, which has declined 15% in the year to date. And just as Singapore is a global financial hub, financial services are a crucial cornerstone to the Straits Times Index and the Singapore stock market. The trio of DBS, OCBC, and UOB make up 20% of our total market cap of all our stocks listed on the SGX, in addition to more than 20% of the day-to-day turnover of the stocks listed on the SGX and more than 40% of the STI. Now, the three banks making up 40% of the STI compared to global banks making up around 5% of the global stock market, around 5% of the FTSE Developed Index, S&P 500, and so forth. And banks have been comparatively more defensive than technology stocks this year, which those bigger, broader global benchmarks that I just mentioned, the FTSE Developed, the S&P 500, FTSE All World Index, for instance, are majority technology weighed indices. So the comparative defensive return really has been mostly attributed to the decline of technology stocks so far this year, which command that much higher sector weight in the global benchmarks. As shown in this bar chart, the STI is majority weighed to banks, REITs, and industrial stocks. And the STI's one technology stock, Venture Corporation, is included under the industrial goods and services categorization that FTSE and ICB both employ. Much like our trade-centered economy as well, close to half of the revenue that's associated with the STI in its weighted form is mostly generated outside of Singapore, mostly in the APAC countries. So we have 49% of the revenue reported to Singapore and 51% reported outside Singapore, and as I said, mostly weighed to Asia Pacific countries. The APAC ex-Singapore revenue, if you look at it closely, it is mostly reported to ASEAN, China, and Hong Kong, and that's a very logical relationship, considering that Singapore's ASEAN neighbours make up more than 20% of our total trade, or 25% of our total exports. China accounts for 15%. Hong Kong also accounts to close to 15% of our exports. So in the day, the strongest STI stocks have also had that regional theme. Yangtze Shipbuilding, Jardine Cycle and Carriage, and Sembcorp Industries. Yangtze Shipbuilding is based in Jiangsu, has reached historical highs in its order books this year, while at the same time benefiting from the appreciation of the US dollar to the Chinese renminbi. Jardine Cycle and Carriage is an auto distributor that reports 90% of its revenue to Indonesia, while Singapore makes up around 60% of Sembcorp Industries' revenue, which of course Sembcorp Industries is undergoing its transformation from brown to renewable energy, making up the majority of its assets, its energy portfolio. And that regional reach that we have very much extends beyond the STI benchmark as well. Last week, on Monday last week, we saw the trio of Golden Agri Resources, First Resources, as well as Bumitama Agri average around 6% gains, bringing their 22 year-to-date total return to around 20%, and that's more than double the gain of the STI. These are our three most traded crude palm oil producers. They all provided their three-quarter updates back on that Monday. Supply and policy developments have continued to put crude palm oil prices in the spotlight this year. Golden Agri Resources has also moved to a top 40 stock by turnover this year, after ranking as a top 60 stock by turnover in 2020 and 2021. And the trio have benefited, obviously, from the average higher selling pricing of crude palm oil this year. For the third quarters, Golden Agri Resources revenue was up 9% year on year. First Resources was up 15% year on year. Bumitama Agri revenue was up 21% year on year for that third quarter. The Golden Agri Resources also maintained an optimistic industry outlook, noting palm oil continues to be traded at, or priced, I should say, at a discount relative to other vegetable oils. And those other vegetable oils are, of course, also facing supply chain disruptions. First Resources, it also relayed that palm oil's attractive relative pricing against other competing edible oils has been encouraging replenishment of inventories from importing countries. And then also on the supply front, Bumitama Agri also noted that extremely rare triple dip La Nina event, or the weather phenomena, as they note, is expected to last into early 2023. But back to the STI and that regional flavour, we've got after that most recent STI rebalance, we also saw Emprador join the STI, replacing Comfort Delgro Corporation. Emprador doesn't have a big free float, around 15% free float, which is the minimum for STI placement, and therefore has an indicative weight of 0.4% in the STI. And also looking not so much from a sector perspective, but from that familiar microeconomic thematic, we should note that Keppel Corp, Singtel, City Developments have also ranked among the stronger performers this year, with Singtel also drawing the highest net fund inflows for the year to date, which are around 950 million Sing dollars as of the moment. These stocks, they have also been among the group of stocks that have been pushing strategic initiatives to restructure or pivot to new business activities and to add shareholder value as well, which obviously can include acquisitions and disposals. Singtel is transforming the NCS business to a digital champion. It's made a significant disposal this year as well, with the Airtel shares. The City Developments, or partial divestment of the Airtel business. City Developments has also followed a strategic capital recycling initiative to unlock what they term as latent asset value. And you've got Keppel Corp obviously also pursuing that transformation to the integrated sustainable urbanisation provider under its Vision 23 mandate. And of course, Sembcorp Industry, as we said, is pressing ahead with its strategic transformation from brown to green energy. Other examples of this strategic restructuring that we've seen in our stock market, this strong microeconomic theme of really narrowing in and enhancing business efficiency and operational efficiency where possible. You've got Capital Land Investments completing its transformation to a real estate asset manager. Look back last year, I think September 2021, and Wilmar also listed its YKA business in China, remember, in 2020. So just rolling into just what we've seen over the last month. The past 1 month has actually seen the STI gain 9% from the 21st of October session that preceded that Deep Valley holiday. I think it was on the 24th of October, right through to the 21st of November when the close was at 32.50. So that momentum, it really commenced with a US-led rally that saw the STI ultimately retest that 3,300 level back on Thursday and Friday last week. And that key level was last tested back on the, the 13th of September and the 11th of August. So during this 1 month of trading activity, Singapore's 100 most traded stocks, they saw $730 million of net fund inflows. And past month, basically really did see marginally less hawkish outlook for US interest rates build. And that brought 10-year US Treasury yields from above 4.2% to around 3.8% where they are now. So that's down 40 basis points. While at the same time, the US dollar index also declined close to 5% from 113 down to 107 at the moment. And then on the other side of the world, up to our north, you had the outlook for China growth helped with a slew of policy moves that included COVID rules to bolster the economy, or to optimize COVID rules, I should say, fiscal support to small businesses, in addition to this series of supportive property measures, of course, that were reportedly introduced, including 16 measures co-released by the PBOC and the CBIRC. So what we saw was semiconductor stocks, which had been the least performers in the world globally, while the energy stocks had been the strongest performers globally this year. We saw the inverse occur. So over the past 4 weeks, for those two sectors, that reverse has applied, with the semi stocks among the best performers and the global energy stocks among the least performers. And this also saw the telecommunications, the banks and technology sectors book the highest net fund flows over the past month, proportionate to their relative current market capitalization over the month. So what I'm saying is, I'm not just looking at the absolute amount of the net fund flows, but also this column here, this 1 month net fund flows over market cap, is looking at the net fund flows relative to the actual size of the stock. Because otherwise, usually when you look at net fund flows, as we can see here in this top table, it's usually dominated by the biggest stocks with the biggest market capitalization. The second table is ranking the 10 of the 100 most traded stocks this year, the 10 stocks that saw the highest net fund inflows proportionate to their respective market capitalization. So as you can see, UMS Holdings, for instance, had close to $7 million of net fund inflows, and divide that by the market capitalization of the stock, which is around 820 million Sing dollars, then your 1 month net fund flows proportionate to market cap is about 0.8%. So therefore, that was the third highest ranking stock for the net fund inflows relative to the size of the stock. We saw the telecommunications sector, as we say, lead the net fund flows on a relative basis, and that was really driven by Singtel, which saw $154 million of net fund inflows over the past month. That's brought its year-to-date net fund inflows to $940 million, which is the top ranking stock for net fund inflows so far this year, with OCBC ranking second at around 565 million Sing dollars of net fund inflows so far this year. So together, the three banks have seen 502 million of net fund inflows for the month, and that represents 0.25% of their combined current market capitalization of 197 million, and that's where they are here on this table ranking here. So meanwhile, as we said, the energy, the materials and resources, the utility sectors that had been defensive going into the past month, they did see the most proportionate net fund outflows. So among the 100 stocks, the 10 stocks that saw the most net fund inflows proportionate to their current market cap, that included 4 tech stocks: Franken Group, UMS, iFast, and Venture Corp. I should also mention Catalyst-listed ASEAN Partners, which is a homegrown engineering duct manufacturer, also ranked here, as you can see, seeing it's like 110 million of net fund inflows on a $21 million market cap stock. Now, this stock has actually seen 80 times trading turnover growth in the first 10 months of 2022 versus 2021. Back on the 27th of April, the stock announced several significant new sales orders for the supply of coated ducts and fittings, and they had an aggregate value of between 16 million and 17 million Sing dollars. Then I think it was early August, 11th of August, after providing guidance on the 21st of July, ASEAN Partners announced group first half gross profit increased 206% to $5.7 million. And also the company did provide an outlook for the remainder of the year. And it did note how semiconductor manufacturing did have the tempo of it per se did influence their outlook. So investors, please do have a look at the corporate announcements and so forth if you want to see any more detail on these stocks and so forth. I've got the whole 100 stocks, if you will, on our market update page, which I think SIAS carries for us as well. But I should also mention 5 of the stocks that saw these highest net fund inflows proportionate to market cap were also among the 10 strongest stocks of the 100 for the last month in terms of performance. They were Franken Group, UMS Holdings, CDL Hospitality Trust, iFast Corp, as well as ASEAN Partners. As well as ASEAN Partners. So I should also mention the stocks that saw the biggest net fund outflows proportionate to their market cap over the last month. That was the Place Holdings, Nanofilm Technologies International, Golden Energy and Resources, Hong Kong Land Holdings, and Geo Energy Resources. Those 5 stocks actually led the decliners for the month, while Nanofilm Technologies, the Place Holdings, as well as Golden Energy and Resources were also among the stocks that booked the highest net fund outflows proportionate to their respective current market cap for the month. And I think SATS and ComfortDelGro Corporation were alongside them. So I'll finish off now, but just to end off, the current global outlook, obviously, for growth, trade, and inflation, in addition to the Ukraine crisis, it does remain highly fluid, and this has created very much dynamic or sensitive market conditions. And as we say, we've seen our Singapore stock market very much on the move for much of 2022. And I'll just try to, really appreciate the time that NetLink and SIAS have given us to share with you just what's been happening in the last month, because it has, as we say, been a very dynamic market. What we do see this week, more focus obviously on the Fed Reserve and the outlook for interest rates. And it doesn't take much Fed speak, doesn't take much data to change expectations markedly. So as we say, we expect the market to keep moving a lot, and very much looking forward to this next presentation now, Rebecca. So if you want to bring Yu-Hing on, who of course is our CEO of NetLink Trust. And I think I worked with you once at City Infrastructure Trust a long time ago, if Yu-Hing. So I'll mute myself and stop sharing the slides, and really looking forward to hearing from you. Thank you.
Thank you, Mr. Jeff Howie. Up next, Mr. Tong, over to you.
Thank you, Rebecca, and thank you, Jeff. A very warm welcome to all of you joining this session. A good evening to all of you. I will go straight into the presentation, and I could take the Q&A thereafter. This first slide 3, describe our business. NetLink is a fiber to the home operator in Singapore. We provide fibers. We install and lay fibers into all the homes in Singapore, and also to commercial buildings all over Singapore. So if you look at this slide, on the left, you have NetLink Central Office. We operate from 10 central offices across the island in Singapore. With the 10 central office, we have network that serve all buildings in Singapore. So following this picture, you will see NetLink Central Office. We will have underground ducts, and within those underground ducts, we will have fibers to the high-rise building or low-rise building. And in total today, we serve 1.47 million residential end users, and we serve 51,000 non-residential end user. We also serve end users that uses our fibers for connecting to sensors, Wi-Fi hotspots, and so on. We call this embed connection, non-building address point. Basically, non-building address point simply means locations without a postal code. Over to the next page. A lot of investors ask us about our business, about our fiber assets, the longevity or the useful life of our fiber assets, the usefulness of our fiber assets, and also questions around broadband prices, competition, and so forth. And therefore, we have decided to put together this slide to explain and also answer some of these questions. I would say our business is future-proof. Today, for fixed broadband delivery in Singapore, fiber is the only means of fixed broadband delivery. What does it mean? It means that to have a broadband access in Singapore, you need to use our fibers. For all home users, you need to use our fibers for their broadband access. This is different from some other countries. In many other countries, broadband internet connection is delivered via fiber, copper wires, coaxial cable, or some other means, including satellite. So Singapore is a bit unique. 100% of all home broadband internet connections are delivered with our fiber. We have a very high penetration rate, 95% residential penetration rate. What this means is that for all the homes in Singapore that is connected with our fiber, 95% of them are using it for broadband access. The other 5% have fibers in their home, but they are not using any broadband connection. Fiber broadband prices are also lower in Singapore than in many other countries. This makes fiber broadband very attractive in Singapore. Fiber is also a critical infrastructure. Fiber support last mile wireless access such as wireless hotspot. It is also used for connecting to 4G, 5G mobile base station, to sensors and cameras and so forth. So it supports not only home broadband usage, but also connect to all this infrastructure deployed across the island. Fiber capacity is also highly scalable in that the same fiber could be used to carry different speed. Today, most home users will be using fiber broadband with speed up to 1 gigabits per second. That can be upgraded quite easily. If you subscribe, you can subscribe for a 2 gigabits link. You can subscribe for even a 10 gigabits link today using our fiber. So that's why I said that fiber capacity is highly scalable. It can support future transmission technologies. It has also a very long asset life and useful life. Typically, it's designed to last about 25 years. However, once we install it underground, it could last a long time. Over to the next page. Here's a quick look at our financial highlights. We announced our half-year result for the period April to September this year, 6 months. We announced the result earlier this month. Revenue increased by 6.2% from 1.87 to 1.99.6 million. And EBITDA or operating cash flows increased by 15% to reach 145.6 million. And a few other key numbers. Net gearing, we have a very comfortable level of debt, only 18.6%. We have a weighted average debt duration of 4 years. What this means is that the bulk of our debt is not due for another period of 4 years. So we do not have significant refinancing risk. And the bulk of our debt are also hedged. So we are also not facing any significant interest rate risk. Market capitalization today is about 3.5 billion. Over to the next page. Here's a quick look at the type of fiber connections that we have. Residential, we ended the half year at 1.474 million. Non-residential, 51.6 thousand. Non-building address point, 2,500 over connections. And we also have another category called segment. This is the category that includes all other type of fiber connections, point-to-point, building-to-building type connections. We have about 2,400 connections here. Over to the next page. Okay, here's a look at our business model. I like to use this slide quite a lot to explain our business model. We have a very stable business model. If you look at the first 4 columns, residential connection, non-residential connection, embed connection, and ducts and manhole service revenue. In total, these 4 columns or these 4 revenue streams contribute about 80% of our total revenue. And they are very stable month after month, year after year. They are very stable because once a connection is made, most users will continue to stay using the connection. They will not terminate the connection. Users may switch from one operator to another operator because they could choose to sign up a fiber broadband package from one operator for 2 years, and then they switch out of that operator to another operator, say from StarHub to M1 or M1 to StarHub, vice versa. That doesn't affect our fiber connections. Our fiber connections stay on, and we continue to receive a fee for leasing the fiber to the operator. So for residential connections, that contributes 61% of our total revenue. Non-residential contributes about 8%, and so forth. So in total, these 4 columns, about 80%. The 4th column, ducts and manhole service revenue, is derived from the leasing of our underground ducts to Singtel. So Singtel pays about 7% of our total revenue on an annual basis because they use our ducts for some of their cables. On the right-hand side, you will see installation-related revenue and ancillary project revenue. These 2 categories of revenue are activity-based. Basically, I can give you a quick example. One example under ancillary project revenue is, let's say, for example, LTA wish to construct a new station or new MRT line. They will require us to move the cables away, and they will contract us to move those cables away, and they will pay us revenue under this category. So depending on the level of construction activity across Singapore, these ancillary project revenue will fluctuate a bit, sometimes a bit more, sometimes a bit less. Actually, over the last 2 years, the level of activity is quite high. Installation-related revenue are for works that we perform for other telcos. They may want us to install fibers or install some fiber points in certain location, and then we will charge them. On the right-hand side, you will see co-location and other revenue, as well as central office revenue. These 2 are for the leasing of space from our central office to telcos. Again, very stable. So if you look at our business model end-to-end, it is a very stable business model. The cash flows are recurring and very predictable. Over to the next page. Strategic focus. What are our focus for this year and beyond? We will always seek to improve our network reach, densify the network, meaning we will invest in the network to extend our network to reach new housing estates. And even in matured housing estates, we will also densify the fiber connections as and when needed, meaning putting more fibers into the ground to serve buildings in those areas that need more fibers. And we have also, over the years, enhanced our fiber network so that it could serve not only buildings, but also outdoor infrastructure. Next, we also seek to improve our NetLink fiber competitiveness in enterprise and government segment. For those of you that have been following us will know that other than the residential segment, we are also active in the non-residential and the enterprise segment. In the non-residential and enterprise segment, we compete with other telcos because we are not the only one providing fiber connection. So there are other telcos that also lay their own fibers, so they would compete with us. Next is to pursue a favorable regulatory outcome, especially this year, because we are currently in a price review exercise, and I will talk a bit more about this later on. We also are keen to explore opportunities to invest in telecom infrastructure businesses overseas. And lastly, we have been engaging end users through our brand awareness program. Actually, we have a brand awareness program with videos and short videos and other infographics to engage end users, to inform them about what we do to raise the level of brand awareness. Next. Here's a quick look at our half-year result. Revenue is 199.59 million, 6.2% higher than the corresponding period last year. EBITDA 145.5 million, 15% higher than the corresponding period last year. I think more importantly is the number EBITDA margin. It is 72.9%. It's a pretty high EBITDA margin, higher than the corresponding period last year. And then we have depreciation, net finance charges relates to the interest that we pay for our bank loans, and a profit after tax of 53.7 million. Revenue for the half year was higher, mainly because of higher ancillary project revenue, connection revenues, and other co-location and installation related revenue. And EBITDA was higher by 15%, actually mainly due to lower operating costs. And last year, during the same period, we also have a write-down of 12.4 million. This is due to a remeasurement loss recorded in that period because of a change in rental rates of our central office. Over to the next page. Here's another look at our financials. On this page, we look at the credit metrics and cash flow. So gross debt is 690 million, and average debt duration 4 years. Net debt to EBITDA actually is 1.8 times. Actually, it's a very comfortable level. EBITDA interest cover 24 times, and most of our borrowing are hedged. You can see that 73.9% of our borrowing are hedged, and the effective average interest rate is about 1.9%. During the current period, 1.9% is, I would say, is an attractive rate, and they are fixed for over the next 4 years, largely fixed for the next 4 years. Okay, over to the next page. Here's a quick look at the distribution. We just announced our distribution. In fact, we will pay our half-year distribution of 2.62 cents per unit end of this month, on the 30th of November. Taken together on an annualized basis, the distribution yield is about 5.79% based on the unit price as at 30th September 2026. Based on current unit price, actually, this distribution yield is closer to 6%. Over the next page. I have 2 pages on sustainability. We take this seriously. We started sustainability reporting a couple of years ago, and we have been improving and spending more time on this area. Our business practices, what we do, right? We maintain island-wide fiber coverage. We want to ensure that a very high level of network availability, and we are also very serious about maintaining 0 cases of corruption and 0 cases of breaches of law and so forth. With regard to the environment, we will make sure that we are fully compliant on all the waste disposal practices, because we do have waste disposal, because we buy a lot of fibers and we use a lot of fibers. Unfortunately, that means some of the fibers will be fiber waste. Once we cut the fibers to a certain length, connecting point A to point B, there will be some excess. We try to reuse as much of it as possible. We have asked our contractor to reuse as much of it as possible, but nonetheless, we do have some fiber waste. But our target is to keep it to below 1%. On the right-hand side, you will see our targets with regard to our people. We target a reasonable level of turnover rate. Unfortunately, we cannot have a turnover rate of 0. In Singapore, that is almost impossible. And we do have a different program to engage our employees, and making sure, I think importantly, to make sure that we maintain a 0 work-related incidents resulting in serious injury. And so far, I'm pleased to say we have been able to do that. Over to the next page. This is a page on our target. We target to reduce Scope 1 and Scope 2 emission by 50% by FY30, using FY22 as a baseline. So we are working towards that, and also hope to achieve and target to achieve net zero by 2050. How are we going to achieve this? I think we have already identified the strategies to achieve this, especially the 50% reduction target by FY30. We will replace existing lights in our central offices. We will also install a detection system to detect leakage of refrigerant in our existing chillers. All our central offices have fairly large chillers for cooling. We will also seek to replace this chiller at the appropriate time to use more efficient chiller and more environmentally friendly chillers that use better or environmentally friendly refrigerants. We will also seek to replace our diesel vehicles with electric ones. I've come to the end of my presentations. I will hand it back to Rebecca, and happy to take any questions thereafter. Thank you.
Thank you, Mr. Tong. We have now come to the Q&A session. May I now invite Mr. Benjamin Goh, Head of Research and Investor Education from SIAS, to moderate the Q&A session. Over to both of you.
Thank you very much, Rebecca. Very warm welcome. Good to see you again, Yu Heng. How are things?
Very good.
Okay, thank you very much for the presentation. Quite robust growth in your revenue as well as your EBITDA. So congratulations on that.
Thank you.
We do have a couple of pre-submitted questions. So the usual suspects, things like your growth strategy, your debt load, interest, so on and so forth, and some questions on very specific to your company regarding the pricing regime. So let's hit into it. So let's talk about the growth. So what is the growth potential of NetLink? Will new technology like 5G be good or bad for profitability? And if you could, maybe you could add some color to the projections for the next few years.
Okay, thank you. Thank you, Ben, for the questions. I think growth is something the management and the board of NetLink is focused on, obviously. As a business, we need to focus on that.
Mm-hmm.
Growth will continue to come from our core business, which is fiber to the home business. And also, when I say fiber to the home, I'm using it loosely. It will cover also fibers to the businesses and so forth. And there will continue to be growth coming from fiber to the home because we often get the questions about, oh, right now you already have achieved 95% penetration. So, everybody that needs fibers already have a fiber connections for their broadband. So where is growth going to come from? That is a very good question. However, we must recognize that Singapore continue to have a lot of new builds. Every year, there will be about 25,000, and in some year, up to 30,000 new homes being built. So this will always continue to be a growth area for us because all of these new homes will need fiber connections. So there will be between 25 to 30,000 new homes every year that potentially will get connected, and they should get connected, right? And to address the question about new technology and 5G, I think 5G has been around for some time. And it will be island-wide by 2025. Obviously, we also pay close attention to 5G, but we see 5G as complementary to our fixed fiber broadband network. Anyone using 5G would also like to use a lot of fiber broadband connections for their data transmission at home. So we see as complementary. We are not seeing any trend of people just because they have 5G mobile connection deciding not to have a broadband at home. Because at home with a fiber broadband, you could use it not only to download, to watch streaming videos, but you could share the Wi-Fi with a lot of people at home. So it is very convenient to use a fixed fiber broadband. We have also asked other operators, similar fiber operators elsewhere, what are their experience. I think the answer is the same. The answer is the same, and they don't think 5G is a threat to a fixed fiber broadband. What about other technologies? I think we get asked also about other type of technologies that would there be other technologies that will eventually be a threat to fiber? As far as we can see in the horizon, there's nothing. Not even Elon Musk's Starlink satellite communication network. Firstly, it's not suitable for Singapore. It's more suitable for rural areas whereby connecting a fiber or connecting some kind of other wireless means is too expensive. Then they will want to use a satellite dish to receive the Starlink connection. Then it was actually very useful for those people that live out in the mountains or some rural areas. Then it was actually very useful. But you need space to put a dish and unobstructed view of the sky. So it's definitely not suitable for use in our country. I think I'll stop here for your next question. Yes.
Okay. So thank you very much for that. Naturally, it does appear that 5G is complementary to the fixed broadband, simply because even at my house, sometimes it's very hard to get reception. It's quite annoying when you're doing a WhatsApp, meeting or a Zoom meeting, and then it just cuts off, right? So, and I suppose with regards to Starlink, it's not even suitable for our, Singapore Army live firing area because it's simply too small as well. So yeah, certainly do see the rationale that these are just complementary products.
Yeah.
There is a question here regarding the relative small size of the Singapore market. So you mentioned that every year there are about 30,000 new housing units being built. I suppose at some point we're going to be building all the way to Batam. I don't know. So is that a concern that at some point, the growth is not going to be sufficiently large enough simply because of the small geographical area of Singapore?
No, I think if you look at the URA master plan, you will see that a lot of areas are earmarked for new housing well into the future. So for the foreseeable future, there will still continue to be a lot of new housing. We can look at the URA master plan. And I forgot to mention that our growth not only come from connecting to new household, but will also come from connecting to especially outdoor location. We are seeing more demand for, I would say a lot of demand, so I won't want to give the impression that there's a lot, but we are seeing certainly more demand for connection to smart lampposts, whereby more sensors are placed on those lampposts. For example, in some new housing estate in Punggol, there are smart lampposts, and there will be other applications that require fibers outside of the homes, right? And also, there are customers or end users that require more than one fiber. For example, the schools in Singapore, they have more than one fiber connecting to them. They want a diverse fiber, meaning they want a fiber to come from different central offices to serve them. You see, most of us have a fiber that come from one center. If you live in Bedok, you have one fiber that come from Bedok central office. But a school in Bedok will have a fiber that come from Bedok central office and another one that come from, let's say, Tampines central office. That will be a diversity product that we offered them, because if there's a cable cut, then they won't be interrupted. Unfortunately, you know that there are cable cuts. Unfortunately, if you ask me, too many, right? But it's sometimes not something that we can control. Contractors that dig the road, sometimes they make mistakes and they cut our cables, and then we have to fix it. Yeah.
Okay, but there's a penalty, right? The last time we spoke, if they anyhow cut the cable, then you go and fix it.
Actually, there is a protocol in place. They have to buy plant maps. When they are ready, they have to call us to locate the cable and so forth, so that this would avoid the situation of them cutting the cable. But it still happens, right? Because sometimes the construction can carry on for a long time and people forget. And then they start to dig into areas they are not supposed to dig. So this happened. And obviously, there are penalties, and the regulators will look into each of these issues, investigate each of these issues, and sometimes take them to court.
Oh, okay. Quite serious.
Yes.
I guess it is quite serious. I mean, somewhere interrupting my Netflix binge watching, when I make them pay for it. Okay, jokes aside. Now, one question that, I had a bang on my mind, right, is that, and since we're talking about new technologies like Zoom, video calls, so on and so forth, it appears that all these new apps are releasing a lot more I guess, requirements on the speed as well as the broadband of the fixed broadband cable, so on and so forth. Doesn't that imply that there's some kind of race here? Because the more we use, usage goes up, you need to have better technology and, I don't know, better cables to transmit the information. And doesn't that imply, more capex, so on and so forth?
Yes and no. I think in general, we have a fairly new fiber network. I would say fairly new because these are designed to last a long time. We just laid on this fiber network. And today, most users are using up to 1 gigabits per second. They sign up a package, 1 gigabits per second, and that is actually good enough. for many applications and for sharing. Let me refer to using a home user as an example. They could use it to meet all these needs. You can Zoom, you can watch video at the same time, and different household member can share the Wi-Fi at the same time. So the fiber itself is good enough. It can handle this capacity. And 1 gigabits is a lot. Although I would say 1 gigabit is a theoretical speed. When there's a lot of people using, you may not get the 1 gigabits per second because it's shared. But a lot of it actually, if you do not get a very good experience, it's probably due to the Wi-Fi rather than the fiber. The Wi-Fi router that you have, because Wi-Fi itself use a certain frequency band that is shared, and your neighbor's Wi-Fi could affect your Wi-Fi, because once you switch on your mobile, you check what Wi-Fi network is available. You can see a number of Wi-Fi network. They're all using the same frequency band. So you can see that all these could be affecting you, right? But the technology has moved on. Actually, there are different Wi-Fi technology. Most of us should be using Wi-Fi 5 and Wi-Fi 6, right? Yeah. And Wi-Fi 7 should be with us maybe in a few years' time. So it's moving up the curve also. And each of these technology, the different level, are providing a better experience, a faster speed, and they can handle more devices at the same time, and providing each one with a wider bandwidth as well, each user with a wider bandwidth as well. So the user experience should be pretty good in Singapore, especially, even if there are many users using the same Wi-Fi at home. I think it should not be a problem. It may be a problem in some other countries because they don't even get 1 gigabits per second. Say in the UK or in Australia, it's quite common that they have a fiber broadband speed of up to 100 meg. So 1 gigabit is less common in those countries.
Yeah, I'm constantly amazed at how fast our speeds are, and usually you sign up for a broadband on a 2-year contract. Mine is almost up, and same price, but they're gonna offer a 2 gigabit, just double the speed. So every 2 years it's kind of like double or something, same price. It's amazing, and as you mentioned, some other countries, they are going on 100 megabits. That's like
yes.
Yeah. Okay. Okay, there are some questions regarding the regulatory review as well as the new pricing regime. So obviously, NetLink provides the infrastructure, bandwidth, so on and so forth. And I guess it's regulated more or less like a public utility. So the pricing needs to be done in conjunction with government officials. So maybe you could add some color regarding the new regulatory regime.
Yes. We have a regulatory asset-based framework. What it means is this. We are required to invest in the fiber network to make sure that we provide fiber to the home to all users in Singapore who requires it. So, and all of this investment in our fiber network, the fiber itself, the underground ducts, are all included in what I call the regulatory asset base. So our CAPEX, our total CAPEX. And the regulator will recognize the total amount that we invested and agreed with us on a rate of return. Currently, our rate of return is a pre-tax WACC of 7%. So with that pre-tax WACC of 7%, the agreed total CAPEX, right, our regulatory asset base, they will work out target revenue that we are supposed to make every year. So the target revenue will not only include a return on the CAPEX that we invested, but also include our operating expenses. So they work out target revenue that we need to earn every year, to compensate us for making all those investments. And for all the investment, for every investment dollar that we make, the regulator will give us a 30-year, sort of on a branded basis, about 30 years regulatory depreciation, meaning they will return the investment back to us over 30 years, plus giving us a 7% return based on the current rate. That's what they do. This is the regulatory regime. And I think a lot of people would ask, oh, then how is the end user price determined? How do I charge each end user, right? So with this target revenue, the regulator will require us to make a projection of the total number of end users. So you just divide the revenue by the number of end users. If I have more end users, then everybody pay less. If I have less end users, everybody pay a bit more. So today, that number works out to be $13.80 per month for each home user, right? For the business user, it's different. It's $55. So $13.80. So if you pay, Benjamin, if you pay your broadband operator $40, for example, for your monthly broadband fee, they will pay us $13.80. Even if you pay $35, they will still pay me $13.80 because that's fixed.
Yep.
So today, we get paid $13.80 on the 1.5 million end users out there that is using our fiber. So quite easy to work out our residential revenue, which is $13.80 times 1.5 million end user per month. And you multiply by 12 months, that will be my annual revenue from the residential segment. And you will know that just now I mentioned the residential contributes 61% of my total revenue. The rest, 8% from non-residential. So we will use the $55 multiplied by the number of end users we have and so on. I think this is a good framework for a business like us because it will incentivize us to invest in the network, to continue to invest, because every dollar we invest in it, we will be compensated by the regulated return. They will review, the regulator will review this every 5 years because after a 5-year period, they will look at all the numbers, the total amount that we have actually invested, and also what is the forecast total amount that we will invest in the next 5 years, and also take into account the total number of end user at that point in time and over the next 5 years to work out what is a new set of pricing that will apply over the subsequent 5 years to make sure that I get a return on whatever they have invested.
Yeah.
Right? At the most important number or two numbers will be the total amount of capex I spend, as well as the rate of return. The rate of return will change every 5 years. It depends on various factors, importantly, interest rates, risk-free rates, and so forth, right? And also the market risk premium and so forth. They will do the calculation. And right now, actually, we are in the process of this negotiation or discussion with the regulator because we will be coming to the end of the first 5-year period, December this year. So the regulator would be ready, I think, sometime maybe next year, early next year, to announce their decision on the pricing for the next 5 years.
Early next year, okay.
Yes.
All right. Okay, thank you very much for that. There were quite a few questions about that, but it sounds like the discussions have been carried on for some time, and once you explain it, the business model is quite clear and quite straightforward.
Yes.
I mean, I like this kind of businesses, when the business model is quite clear. Unlike what Elon Musk is doing with Twitter, nobody has any idea what the hell is happening. So, but this one is like at the back of the mind, you can do some quick calculations. You kind of already know what's the ballpark. So, quite straightforward. And I guess it's also beneficial to players like StarHub, Singtel, so on and so forth, because the pricing is also pretty straightforward. So as you mentioned, they pay you $13.80 and they charge me $40 or whatever it is, and the rest of it is,
Yes.
their margins. All right, sounds good. Okay. Next question here is perhaps you could provide some guidance regarding the distributions or dividends.
Okay. What we like to do, because investors are attracted to our stock, NetLink, because of the stable business model. And a lot of investors, retail as well as institutions, would like to receive a stable distribution every half year. We are doing half-yearly distribution. So they would like to receive a stable distribution. If our distribution fluctuate too much, I'm sure a lot of investors will be very unhappy. So we are very mindful of that. So we target a stable distribution, making sure that the cash flow generated by our business will continue to support that level of distribution. if you have been following us since our IPO 2017, you will see that the distribution has been very stable and actually has been growing. And today, our distribution for these last 6 months, which we just announced, 2.62 cents, is about 2% higher than the corresponding period last year. So I think what we like to do is to maintain a stable distribution. And that 6-month distribution amounts to 102 million. So let's say, for example, you annualize it, it's 204 million cash. Can we afford to distribute this level? Of course we can. Because if you analyze our EBITDA, let me look at my own EBITDA number. My EBITDA is 145 million. So you analyze it, I'm making it simple. Analyze it will be 290 million. So we are distributing 204 versus 290. But I have to point out, 290 is not just for distribution. It's also for paying costs of the debt, right? The interest on the debt. But our interest is quite small. So we have sufficient headroom. Then you may ask me, then what about the balance? Why don't you distribute everything? The balance is used for reinvestment into our business. So we use a lot of the cash generated to reinvest in our business. If you look at our capex every year, we continue to invest in our business. So this is a growing business. And investment is good for our business because of our regulatory model. All investment into our business, new capex into our business will attract a rate of return, the regulated rate of return. So that's good. Actually, that means we continue to have investment opportunities. We continue to invest to expand our network. And we are able to maintain a stable distribution to investors.
Okay, thank you very much for that. There is a question here about capex, now that you've mentioned it. So what is the capex guidance going forward? I imagine the level of capex that you spend every year is kind of proportion to the number of users, so on and so forth.
Okay. Yes and no. Generally should be the case because I mentioned the 25,000 homes being built every year. So that means somewhere in Singapore, there will be new HDB flats, condos being built. So we need to extend the network to those new areas. So there will be a steady amount of capex every year for this purpose. Digging the roads, putting pipes and fibers to those new homes and all that. And we add to that, because we expand our network to make it more flexible to serve outdoor locations. So over the last 2 years, 3 years especially, we have been making investment to make our network more flexible, not just fiber to the home, but try to run fiber along the streets and also to certain locations so that if there are users, HDB void deck, multi-story car park, or somewhere in between, we could serve them if they need to put up a sensor. So over time, we have made our network more flexible. How do we make it more flexible? It is by putting more fibers to different locations and being ready to serve the user if they need a fiber connection at a certain location, outside of a building in particular. So we continue to invest. If you look at our record, initially in 2017, after IPO, we spent, I think, 212 million or so capex that year, but that is a bit one-off because we bought more assets from Singtel. Thereafter, it tapers off to about 70 million a year, at thereabout, plus minus a bit. So we have been maintaining that level. But this year and next year, maybe a bit more, because we have also announced that we're going to build a new building, a new central office in the northern part of Singapore. So that will cost us quite a bit. I think we have announced it could cost us up to about $100 million. So that will be spread over a 2 years, 3 years period of time. So we will be spending more capex because we are building a new central office. This will be a central office that will serve new buildings that will come out in the northwest of Singapore or northwest of Singapore for a long, long time. So there will be new buildings coming up in that area, and we figure out that we need a new central office to serve that area better. Right? We are also spending some money on IT to upgrade our IT system. So you will see later on this financial year or this coming financial year that the capex will grow up a bit. Yeah.
Okay. All right, fair enough. Okay, now let's see. Okay, we do have a couple of questions apart from the pre-submitted questions that have come in. Let me see. So one question is about the pricing regime. We've already discussed that. The other question is about NetLink fiber becoming obsolete with new technology. We have also discussed that one. So I'm just quickly running through here. We've talked about DPU. So is it fair to say that DPU, distribution per unit, is unaffected to the rise in interest rates? And I guess in conjunction with that, I did take a quick look at the debt load of NetLink, and at least from Bloomberg, it says that there's $500 million worth of debt expiring in 2026 and a little bit more in 2027. So as you mentioned just now, the majority of your debt is already hedged. So perhaps you could again provide a little bit more color about that, and with respect to, as well as respect to the DPU.
We are quite comfortable where we are with the debt, and we are quite happy with it because we fixed it last year.
Okay.
So we fixed at a good rate, and the bulk of it, right, 500 million will be due only 2026. So we have 4 years to go, and the rates are fixed. So we're quite happy with that, right? A smaller amount will be due a bit earlier, but that's a much smaller amount. If you look at our net debt EBITDA, we are 1.8 times our debt EBITDA. Similar companies in our space, companies that provide infrastructure with similar business model, typically have a lot more debt. 5 times is not uncommon. We at 1.8 times, we are quite comfortable now. With the rising interest rate, I think we don't want to add on too much debt at this point in time. So we are quite comfortable with that. And I guess the question the investor may ask, would rising interest rate affect DPU? I think I already explained, if we don't have to pay more interest costs or significantly more interest costs, then it shouldn't affect our DPU because our cash flows will remain healthy. Yeah.
Okay. All right, that makes sense. Thank you very much for that. There is a question here regarding the your presentation. So you mentioned that there's some competition with regards to fiber installation. Would you be able to comment a little bit more on that? Is it a significant threat?
It's not a significant threat. The reason there are competition is this, right? NetLink started laying fibers around 2008. Even prior to 2008, other telcos in Singapore already have fibers, just that they don't have fibers to all the homes, which is why the regulator decided that, hey, we need one company. We need to require one company to build all the fibers to the homes. Otherwise, the homes may not have not all the homes will have fiber. So those companies, telcos, already serving, Singtel, StarHub, are already serving commercial users, some of the commercial users, especially in the CBD areas, so they have fibers. So they have always been serving these customers. In fact, we are the late entrant into this space. But I think we are quite comfortable. Everyone will serve some of the customers in the CBD or outside the CBD. I think the level of competition is a healthy one. We don't see it particularly threatening, right, from anyone. So we will leverage on our fiber network, nationwide fiber network, to provide fibers to any of the business customers that need it. Of course, if they choose to use other operators, they could. Yeah.
Okay. All right. Doesn't sound like a significant threat there. There are a few questions regarding overseas strategy. So specifically, is there any progress on investment in overseas telco infrastructure? Alongside that, previously there was some discussion about NetLink being interested in BTS towers. So any further updates on that?
I think I would say we have been looking at this space for more than 1.5 years. We started this journey. We decided to look at investment outside of Singapore about 2 years ago. But we have not set ourselves a definite time frame because that would be unhelpful. We are not in a hurry. We have a very good business in Singapore, generating very healthy level of cash flow. So we we don't have a need to really go out there to make investments quickly, right? I would say, but you may ask then, why do you want to look for investment elsewhere? I think we want to take our time to look for good investment. We believe there are investments out there that, given time, given the right opportunities, we will be able to find the right type of investment that will not raise our risk profile so much, but yet generate a fairly stable level of cash flows. I will have to say right now, after 2 years, it's not easy to find. The reason is this: we have looked at a number of investment, whether it's fiber network or towers network. A lot of investment funds, strategic players are looking at the same space. So the valuation for towers, for fiber networks, for those completed transactions are very high. We will not pay that kind of prices, which is why we have not invested in any. But we continue to spend time looking at this space. I think with the market volatility, the increase in interest rate and so forth, give it a few more months, the prices will moderate. The sellers will have to moderate their expectations because the environment has changed. It's more expensive to borrow. Buyers will be more cautious and they are not willing to pay such high prices. So it's actually a good thing that we have not invested so far. We are looking at this space. I think if we don't find the right valuation, we will not invest. We do not want to give ourselves the time pressure or the target that we must invest in something. We have a wonderful business in Singapore. And I must add this. It sounds like we are not investing, but actually we are investing every year, at least 70 million, right? We are investing a lot of money and that is earning a good rate of return. So I'm quite happy with our business because this is one business that year in, year out, I can continue to invest in our own business, which is far lower risk, and something that we are already doing. So I think we are in a very sweet spot, when it comes to running a business and with an opportunity to expand,
I mean, certainly going overseas, there is also the regulatory overhang because you need to get approvals and, other governments you need to work with, so on and so forth, right? Okay. So thank you very much for that. There is a ancillary question here regarding overseas expansion. So if you do expand overseas, then how will the pricing be determined? Is that still going to fall under the current regulatory regime where IMD or the government, will have to, work out the pricing, in conjunction with yourselves?
Okay, it's a good question. I think if we invest outside of our regulated business, then it will be unregulated. They will have to look at it. It will be separate, right? So you have a separate balance sheet, separate P&L for that. So anything that we do, even in Singapore, if we do something that is outside of our regulated business, it will be considered as unregulated. And whatever investment we make there will not earn the regulated rate of return. So basically, it's the same for overseas investment.
So it's purely commercial.
Yeah, purely commercial.
Okay. That makes sense. All right. Okay, just to tie off the question regarding the rate of return or the pricing regime, in a rising interest rate environment, does it follow that regulators will also price in a higher rate of return? I guess you mentioned just now your weighted average cost of capital, right?
Yes. So they will have to consider that. You see, the weighted average cost of capital formula depends on a number of parameters, right? One is risk-free rates. So with higher risk-free rate, I think we all now know the risk-free rate has gone up. Singaporeans are paying a lot of attention to risk-free rate, I gather, because fixed deposit rate has gone from nothing to more than 3%, right? So over a very short period of time, so suddenly, if you talk to friends, everybody is talking about FD rates, in a way, right? So risk-free rate certainly has gone up, but our formula actually takes into account, because it's a 5-year regulatory deal, a 5-year regulatory period. So it is not wise to pick a spot rate, what is today. So even 5 years ago, when the regulator worked out the 7% pre-tax WACC, they look at the long run historical risk-free rate. They also look at the prevailing risk-free rate, and they do an average of these two components, historical as well as the prevailing interest rate. So today, they will apply the same thing to work out something. So there'll be pluses and minuses because you look back into history, there are ups and downs as well. So it doesn't mean that automatically, if today you get a very high rate, you will get a significantly higher WACC. But it helps. It helps because at least the prevailing component should be reflective of what is the rate currently in the market.
And certainly that's, the government wants to be fair to NetLink as well, because you are borrowing money to, invest, right? CapEx. So not right if the rate of return is too low.
I think we have very good relationship with the regulator, and I think they are always open to discussion. In this respect, we have had many discussions. Obviously, we have to provide our views, and they will also provide their views with regard to this. I think at the end of the day, it will be an outcome that will be acceptable to us.
Okay, fair enough. Okay, I think in the interest of time, we'll just cover 2 last questions.
Yes.
All right, the first one is about the share price. So there have been quite a few different respondents that came in. So I'm going to say this in a very Singaporean way. How come the share price dropped?
Okay, I think depending on whether you're fixed income investors, equity investors, how you look at the stock, I would say a lot of investors look at NetLink as a yield play. If they look at it as a yield play, then they will compare the yield, the distribution yield. I just mentioned that our distribution yield today, based on today's unit price, is 6%. They will compare that to a risk-free rate, perhaps a T-bills, which is set 4%, Singapore government T-bills, which is 4%. So if the T-bill is 4%, then they would like to have a NetLink stock yield play at 6%, perhaps. Not always this range of numbers, but I think it is not unreasonable for some investors to expect this, because we are not risk-free. We are not Singapore government, right? We are higher risk because we are, at the end of the day, we are listed stock. So what investor is telling us today, I'm just looking at the price today, right? Say, oh, NetLink should be 6%. That's their view, all right? That's the market view of NetLink. I can say what I want, but the market is the market. The market view is 6%. When the government T-bill is 4%, which is why the stock price has dropped from about 97 cents for a long time to currently about 86 cents, right? Because they would like to have a higher yield. If you stay at 97 cents, it will be a 5% yield. I guess to some investors, when the government T-bill is 4%, when they could put their money into a risk-free instrument at 4%, they may not want to put money at 97 cents unit price for NetLink to earn a yield of 5%. So what the market is saying today is they only want to put it money into NetLink at 86 cents. That's what they are saying today.
No, fair enough. So it's like going to a supermarket, you want to buy this, you want to buy that. There are different alternatives. So obviously the risk-free rate is generally quite high nowadays. So as you mentioned just now, so that might provide a viable alternative for people who have less risk appetite. I did some checking just now. I think specifically the concern or the questions here are regarding the precipitous drop in the share price after September, right? Middle of September, basically the share price dropped quite a fair bit, but recovered, and then now it's coming down. So for all our friends out there on the line, I can also say that in September onwards, the performance of NetLink is actually very highly correlated to STI index. It's about the same. The correlation was about 0.9. So it's not really anything to do with NetLink. It's just that the entire market drop law. So it's, again, very Singaporean, like that law. But again, to be fair, in the beginning of the year to date, NetLink has actually been a little bit more stable compared to the STI index, which showed quite a bit of volatility. So in that sense, it's more of a defensive play, just to put it out there.
I
All right.
think for all the, if I may add a comment, I think for all the yield stocks, if you put all the REITs in the same category, yield stocks and all that, year to date, most have fallen between 10 to 20%, on average 20%. You know, it's just a function of the risk-free rate.
Yeah.
Right. So NetLink has also suffered. We have gone down by 10, 13%. So as long as the risk-free rate increase, there is some pressure on the unit price, on the price of the REITs as well as the price of NetLink.
Fair enough. Okay, so that was the second last question. And then the last question is by one of our responders who came in this evening. So this one is about asking you for your recommendation, Yu Heng. So in your view, given your company's relatively stable dividend payout, can this person actually invest in NetLink and use the dividend as his retirement income? Anything between 4 to 5%, this person is happy. So can or not?
I think I like this business. We like our business. It's a very stable business and it's a very long-term business. And the asset will last a long time. I don't have to replace this asset 15 years from now, you know. Some businesses, they need to refurbish, they need to buy new assets to replace it. So this asset will last a long time. What I would say is that the cash flow should be stable. I will not say there is no risk. There is always risk. There's regulatory risk because every 5 years, the regulator will make a decision on return, sometimes higher, sometimes lower. Sometimes we are very happy with it. Sometimes we may be less happy with it. So I cannot guarantee, right?
Yep.
All stocks has some risk in it. And so I will not recommend anyone. So when my friends come around and ask me, I will not recommend, especially friends. Because friends, you recommend your own stock to your friends. You know, your friend could text you anytime, you know, day and night. When the price go up, they never text you. When the price go down, they will text you. So I can't make that kind of recommendation. But I would say it's a business model that I like. And the cash flow is expected to be stable.
Okay. So again, in the interest of sharing, and I'm aware that we're very much over past time already. The business model for NetLink is, you can think of it as similar to ComfortDelGro, SMRT, SBS. It's a public utility, so on and so forth. The pricing is more or less done in conjunction with the government. But unlike ComfortDelGro, which has to contend with Grab and people not going to the office, you know, again, unlike SBS or SMRT, which had its own share of problems, in my view, NetLink Trust is hard to compete lah. I mean, because they own the infrastructure, but what, you're going to build your own fiber cable network? No lah. So it's one of those things which, in my view, as an analyst, I would say that there's an economic moat lah. It's hard to threaten this business model, right? So in that sense, I also echo the sentiment that this is a relatively straightforward and stable business. So take it as you will. It's not going to be Tesla. It's not going to be terribly exciting, but it's going to be slow and steady. And for people who want that kind of dividend yield play, you know, obviously that would be an attractive proposition. Right. Does that sum it all? Does it sum it up properly?
A good summary.
Okay. All right. So thank you very much, Yu Heng. Always a pleasure to have you on here, and very appreciative that you were able to answer almost all our questions, even the relatively tough ones.
Thank you, Ben.
Okay, all right. Eileen, or rather Rebecca, back to you.
Thank you both. So thank you to the panelists for an insightful sharing tonight. We have come to the end of the session, and thank you for joining us this evening. In case you missed any part of today's session, you can rewatch the webinar on SIAS's YouTube channel or on our Facebook. The next Corporate Connect will feature First Read on 6 December. Do join us again for that. And also do visit our SIAS website to get updates on our upcoming investor education programs. So thank you all and enjoy the rest of your evening.
Thank you all.
Thank you very much.
Thank you.
Thank you, Yu Heng.
Thank you, Ben. Thank you, Rebecca.
Bye.
Thank you.
Thank you.
Thank you.